Let's discuss the results of the exercise. Cash was down 50%, which is absolutely terrifying. Absolutely terrifying. Once you have a material decline like this in cash, it could signal that the company could go belly up. Of course, you need one more year of data to analyze it, as one data point doesn't make a trend. Okay, accounts receivable is up 74%. That's concerning as well because we're extending favorable terms to our customers, right? And so it's a cash crunch for us because they're not paying us the cash yet. Okay, inventory, oh my goodness. Wow. Inventory was up over 1,400%. This could bankrupt a company. There's a great example of this with Atari, which was a video game maker back in the early 1980s. They made this game called E.T. based on the movie E.T., and it was such a horrific failure that they actually buried hundreds and hundreds of thousands, if not millions of copies in the desert, right? So a lot of times when you have a spike in inventory, it's because something went wrong, right? No one's buying that product. That's terrifying. Okay, let's keep going here. Long-term assets, I'm not that worried. There's really no change here. That's fine. The building went down $5,000 because of depreciation, which we covered in an earlier section. Let's talk about current liabilities, but I'm really going to focus here on debt. So debt was up by over $30,000. That's short-term debt, right? That's a concern. Let's see what else we have here. Oh, goodness. Long-term debt was up $300,000. So that's frightening. So maybe we took this debt and we're financing the material increase in inventory with partially that debt. Frightening. Okay, let's go to retained earnings. All right, so we can tell our net income from the income statement was $157,000, $875 for calendar year 2016. And we had a small increase here in common shares. So what really worries me about this is the material spike in inventory. It's absolutely terrifying. Inventory spikes like this can, of course, destroy a company. Last thing I'll say is this. Looks like our balance sheet bounced, which is a good thing, right? At least we got the math right here, which is great. Okay, cool. Well, we are done with the balance sheet section now. And let's move on to the cash flow section, which is much easier than you think. And once we understand how all three financial statements talk to each other or how they're all related or linked to each other, then creating financial models from scratch is very easy.